Hey everyone, welcome back to another Explainer. Today, we are rolling up our sleeves, cutting through the media noise, and taking a hard, structured look at the raw financial metrics behind a major market player, Synchrony Financial, ticker symbol SYF. We're going to see exactly what the data tells us through a pure quantitative health check. Let's quickly run through our agenda for today. We're going to start by meeting Synchrony Financial, look at their price and valuation metrics, check out growth and market returns, dive into dividends and cash flow, and finally wrap up with intrinsic value and safety. Let's get right into it. All right, Section 1. Meet Synchrony Financial. First things first, we need to grasp the sheer scale of the business we're looking at. Synchrony carries a massive market capitalization of over $23.5 billion. So, this isn't some tiny speculative startup we're analyzing. This is a very serious institution. When we talk about buying the entire company at its current share price, that's the absolute price tag. But this is where things start getting really interesting. Their trailing 12-month revenue sits at $23.15 billion. If you've been paying attention, you'll notice that is practically identical to their entire market cap. From a pure value investing standpoint, anytime you see a financial business pulling in $1 of revenue a year for every dollar of its valuation, well, that instantly grabs your attention, right? Moving right along to Section 2, price and valuation metrics. Okay, just to make sure we're all on the exact same page, let's briefly define a couple of metrics. The PE ratio, or price to earnings, is simply how much we're paying for a single dollar of the company's current profit. The PEG ratio takes that PE and divides it by the company's earnings growth rate. Generally speaking, a PEG under 1 means you're looking at a stock that might be pretty undervalued compared to the growth it's actually pumping out. And look at how that plays out for Synchrony right now. Their current PE is sitting at a very low 7.22. That's actually running almost 4% below their own 3-year historical average of 7.5. But the PEG ratio? Wow, it's at an incredibly low 0.22. That is roughly half of its 3-year average. Essentially, the market is pricing this company at a massive discount compared to the actual earnings growth it's been generating. And it's not just earnings. Across multiple valuation lenses, including free cash flow, this stock looks heavily discounted. Their price to free cash flow ratio is just 2.45. For a multi-billion-dollar enterprise, that is remarkably low. And it's comfortably below its own recent trailing average of 2.63. The market just seems to be totally ignoring Synchrony's ability to generate cold, hard cash. Which brings us to Section 3, growth and market returns. You can really see the wild ride this stock has been on recently. After getting hammered by the tough macro environment in 2022, dropping over 27%, it came roaring back. We're talking a nearly 20% gain in 2023, followed by a massive, and I mean massive, 74% surge in 2024. If you have the conviction to buy during that dip, you were absolutely handsomely rewarded. But what's actually driving those returns? Well, looking at the underlying fundamentals, this business is a very steady engine. Over both the 3- and 5-year horizons, they've been posting consistent high single-digit revenue growth. But here's the kicker. Thanks to strong operational leverage, that single-digit revenue growth translates into double-digit net income growth. Over a 5-year period, net income has compounded at over 11% annually. All of that profit efficiency results in a highly robust return on equity of over 21%. As an investor, ROE is a huge signal. It tells us exactly how effectively management is using shareholder capital to generate profits. And at 21.34%, Synchrony is incredibly efficient. Plus, that current rate is actually beating both its 3-year and trailing 12-month averages. They are just firing on all cylinders. All right, let's turn to Section 4, dividends and cash flow. For the income-focused folks out there, let's take a quick snapshot of their dividend health. Now, at first glance, a 1.72% yield might not knock your socks off. But wait, look at the safety metrics here. They've hiked this dividend for 4 consecutive years. And even better, the payout ratio consumes barely 12% of their net earnings. Even crazier, it takes up a minuscule 4.1% of their free cash flow. This dividend is basically bulletproof and has so much room to grow. But frankly, the real story here for shareholders is the free cash flow yield. Guys, it is sitting at almost 42%. This metric compares the actual free cash flow generated against the company's total market value. A yield this high means the business is practically a cash printing machine relative to how the stock market is currently pricing it. Just to put a concrete number on that yield, over the trailing 12 months, Synchrony generated just shy of $10 billion in pure free cash flow. Think about that for a second. Remember our first slide? The whole company is valued at $23.5 billion. They are producing nearly half of their own market cap in pure, unadulterated free cash flow in a single year. That is wild. This perfectly sets up our final part, Section 5, Intrinsic Value and Safety. We're going to base our next data point on a discounted cash flow, or DCF model. If you follow rigorous value investing, you know this is a vital concept. It helps us figure out the theoretical fair value of a stock by projecting its future cash flows and discounting them back to today's dollars. And the margin of safety? Well, that's just the discount you get when you buy the stock below that calculated fair value. And here is where the data gets absolutely fascinating. According to the DCF calculations provided in our source material, which heavily factor in that massive $10 billion of free cash flow generation, there is a staggering gap. The current trading price is hovering right around $70 a share, but the mathematically calculated fair value, it sits at over $464 a share. If you crunch the numbers on that, it results in an almost 85% margin of safety based purely on that projected free cash flow. In traditional value investing, a 30 or 40% margin of safety is usually considered a home run. An 85% margin of safety? That literally implies the broader market is violently disagreeing with the underlying mathematical cash flow models. So I'm going to leave you with this to ponder. Does this immense, mathematically verified discount make Synchrony Financial the ultimate value play right now? Or, in the complex world of finance, are there hidden macroeconomic risks, maybe lurking in consumer debt or interest rates, that a pure cash flow model simply can't capture? The data clearly shows a cash generation powerhouse on sale, but the market is heavily pricing in caution. It's a perfect example of why digging into the raw numbers is just so rewarding. Thanks for joining me for this explainer, and keep asking great questions.